Good evening, everyone. Thank you for joining us. I'd like to thank you for joining the first in a series of webinars that aim to be short and informative, presented by subject matter experts in areas of financial planning that may be impactful to your life. Today, we are joined by Megan, who I've known for probably about 10 years now. And during that time, she's not only been an excellent partner in reviewing long-term care needs for equi families, but also caring friend who takes the time to just kind of chat and catch up. So it's been a great relationship, and she's an excellent long-term care planner. So we're lucky to have her here today. We have about 20 minutes and a few slides, and then we'll take some time for Q&A at the end, and we'll have this session recorded and make it available to you as well. So without delay, I'd like to hand things over to Megan.
Thank you. Good evening, everyone. So tonight we're going to take you through long-term care. My goal for everyone is by the end of this meeting, you'll have learned something, I'm hoping, but really just to give you information to help you explore this if it's appropriate for you and your family unit, or determine that this may not be the best fit for you. You're going to see my first slide is entitled long-term care, but I really prefer to refer to it as asset protection, as what we are really doing is protecting the assets that we've worked so hard for in our life from being depleted from an unplanned event. The way we've set up this presentation is that we are going to cover 6 areas. What is long-term care? I'm going to explore the cost of care, both nationally as well as in the greater Seattle area. We will address where long-term care services can be received. What are the options for paying for long-term care? A policy isn't the only option. Giving you some questions to think about whether it's right for you, and then explaining what the process might look like if this is something that you may want to look into exploring at a later time. So simply stated, I like to say long-term care is the type of care that one needs when they come to a point in their life where they're unable to care for themselves independently. I've been in this field for about 30 years, and what I've found is that through hundreds and thousands of interviews with clients is that when I ask, do you know somebody who has ever needed long-term care, I often get a deer in the headlight stare the majority of the time. As we go through and we do some education and I explain and answer some questions, it seems as though a light bulb comes on and people then realize that they do know more people than they thought. And so I like to phrase it with this definition. However, this definition is not the definition used by the long-term care insurance policy. The definitions that are used that would qualify us for long-term care are one of two things needing to happen. Either we need to require assistance in performing two of what are called the activities of daily living. I like to use the analogy thinking back to when we either, if you had children or when you were a child, we came into this world being unable to do a series of actions that we are all probably proficient in at this point in time. And they're our ability to bathe ourselves independently, dress ourselves independently, transfer around, that's getting up and out around your house and out and about. Toileting is the actual act of being able to get on and off of a toilet without assistance. Continence is our bowel functions and holding our bowels and not using the restroom until we are actually on a toilet or in a restroom. And then the last one is actually eating, and that's the ability to feed ourselves independently. That's not the meal preparation itself, but feeding ourselves. So we need to lose two of those activities. Or the second way we can trigger a policy is by being diagnosed as having a cognitive impairment. And so I like to think about that as when our orientation to time or place has been altered. That could be triggered by a car accident where we hit our head on the steering wheel. It could be triggered by a diagnosis of dementia or mild cognitive impairment. So there are a variety of ways, but it's where we're not able to care for ourselves independently and our safety is at risk because of the loss of cognitive abilities. So I thought it would be helpful, and I'm hoping this is beneficial to some of you on this call, to maybe lay the foundation and share a few examples of certain conditions or events that have qualified individuals in my life for long-term care services. I was thinking about this, and as Kyle and I were discussing this presentation, what I realized is that when you work in a field, you become acutely aware of how certain diagnoses or conditions could qualify somebody for this type of product, being a product that I've worked in. And so as Kyle and I were talking about this, I think even he had a couple of, oh, I didn't consider that might be something that could trigger somebody. And so I would like to share these with you. Um, the other thing I would say is that long-term care does not discriminate. Um, any of these list of items, I've put ages by the people without obviously names. It could happen at any point in time. There is a big misnomer, in my opinion, that long-term care only happens when we are older. And actually, that's not really the reality. As you see, I've put on here that 41% of individuals needing long-term care services are underneath the age of 65. That might be startling. I also clarify that or qualify that with the comment that some of us that may need long-term care when we're under the age of 65, it may not be a permanent loss. It could be something that's temporary and that at some point in the future we regain our ability to perform the activities of daily living that I had listed on an earlier slide. Or if we were in an accident that caused head trauma where we were out and our orientation to time or place was altered, we regain those faculties. Those aren't necessarily always permanent, although they can be. So just a few examples to share with you. I had a colleague early on in my working career who was a very qualified skier herself, was up skiing one weekend, and out of her blind spot came a snowboarder that was out of control. That person went right through her knees, and she needed assistance in performing those activities that I listed earlier. I'm going to reference those a little bit in this section. She needed assistance with her ability to bathe herself and dress herself independently for about a 4 or 5 month period of time. You would never think that would happen, but she was fairly young. The other example that I've listed here was actually a friend I used to play soccer with. We were in an indoor soccer season. If you're not familiar, indoor soccer is played in an arena that looks similar to a hockey arena where there's plexiglass around. And he was slammed up against the wall when somebody was going for a ball, and he shattered his leg from his hip all the way to his ankle. It was about 9 months until he was fully functioning and able to move around and care for himself independently. And that was at the younger, tender age of 28 years of age. Cancer treatment. I'm sure many of you on the phone, I find it hard right now for somebody to say that they maybe don't know somebody. If you don't, you're blessed. But so many diagnoses of cancer based upon the type of cancer, the stage, the severity of it, the treatment, could qualify somebody for long-term care services. The next one I share with you is an MS diagnosis. Had a very dear friend diagnosed below the age of 30 with MS, and it did over time, not initially, but over time as we've aged, it's had more of an impact and limited her in terms of what she can do. She is not completely at a point where she's not independent, but she does need assistance on occasion with different activities of daily living. The next one is me. At the age of 29, I was playing soccer. Had never had any knee problems in my life. Went into the doctor because I really couldn't move. My knee was giving out as I was going down the stairs, only to find out that I was diagnosed with osteoarthritis in my one knee, and a mere 2 years after that, osteoarthritis in my second knee. My doctor's comment to me was, "You will need a knee replacement, and that will probably knock you up for a little while, but you can get better. But if you stop playing soccer, you're going to save your knees." So to date, I'm mid 50s. I haven't had a knee replacement, but I foresee that coming. And actually this weekend just hosted a very good friend who's 59 years of age who just had a knee replacement surgery, and hers went perfect. However, I have, on the other hand, I have my oldest friend actually from childhood has had 3 surgeries now over the last year and a half, and she's like, third time has to be a charm, and her knee surgery didn't go well. So she has needed her husband to help care for her for the last year and a half. Probably it's coming up to 20 months now. Lyme's disease. Lyme's disease can present itself in many ways. Sometimes it has a cognitive impairment effect. Sometimes it has a neurological effect. I had a friend that actually had both, and she actually had to quit her working career because of its implications. She sought treatment, but it's been a long road, and that's now almost about 16 years later. She's kind of finally better, but she still has some residual effects and never would have thought, and she was a very healthy person, never her lifestyle, her food choices, everything was picture perfect and what you'd see on paper you should do, and unfortunately received that diagnosis. And then the last one I share with you, because it's very sad, but I'm starting to see this is becoming more and more common, is diagnosis of cognitive impairments at a very young age. 46-year-old, still working, an executive of a corporation, found out that he was diagnosed with cognitive impairment and still had 3 children underneath the age of 18. Transitioning now to the cost of care. If you haven't ever explored or maybe don't have a family member that's ever needed long-term care, or this is your first time looking into this, I just thought it would be helpful to share what the national cost of care look like. These numbers are from 2025. Versus nationally, as well as in the greater Seattle area. And I know some of you may not all be from Seattle, but we just picked those 2 locations. Starting at the top, the non-medical caregiver into the home care section, that is going to be like a home health aide, somebody that's had some basic training, but that doesn't hold a certification like an RN, an LPN, or a therapist, occupational speech. Um, and so that care on average, and that number of showing for national average of $80,000 a year, you'll see the asterisk, that's based upon 44 hours of care in a week. So if one needed less care than that, obviously that number would drop down. But if somebody was in a situation where they needed more frequent care, that number could highly escalate from there. In the Seattle area, you may or may not be shocked to see it's significantly more expensive. Private duty nurses where you have somebody independently in your home, and that on average is running about $4,600, and that's just 1 hour of care per week for a full 52 weeks. Washington State being a little bit less, but the ones that I think are the most startling, and Kyle and I look at these
Hmm.
numbers every year, but we hadn't pulled out 2025, was the 2025 figures for nursing home, a private nursing home room, running about just under $250,000 in Washington State or
I was
nationally.
shocked. I mean, I look at these a lot, but that one really set me back. Wow.
Yeah. And so the only comment I would say is these numbers escalate. You see that change year over year for the national numbers. They tend to go up. The biggest driver for the home health care is going to be the cost of labor. And so the CPI for the labor CPI is what's going to drive that up. What does it cost for the individuals that are providing the care to live in the area? Where care is received, there's a lot of different care settings. One size isn't right for everybody. What I did was I listed the care locations where people tend to receive care. The two that are I've put in the periwinkle or purple color are the most common locations at home and in an assisted living facility. But I think the adult daycare might be new to some of you. Adult daycare is very much like a child care. It's a place where we take our loved one or our spouse during the day. Maybe we're still working. We drop them off. They're going to be socialized. They're going to be supervised. They're going to have food. And then we pick them up. Maybe they're there 5 days a week. Maybe they're there 2 days a week. It's just a place to take somebody so that we know that they're safe and they're not at home by themselves and they're being stimulated as much as they're able to receive based upon their current medical state. Adult family homes, you might see some of those. I know in the greater Puget Sound, there's a lot of these. They're oversized homes housing 6 patients, have a doctor or a nurse that's on staff, and it gives the feeling of still being able to be at home. You're just not in your own home environment. Assisted living facilities, think about a condominium. You might share a room or you might have your own room. You're going to usually have a sink to wash foods. You're going to have a refrigerator. There's going to be no oven or stove. Come down for communal meals. You oftentimes have activities. They might bring in singers, they might bring in art sessions, you might go out on excursions, but it allows people to transition through their care needs. So you might move in there needing a little bit of assistance, but still being fairly independent, being able to have neighbors next to you, socialize with people, and then it allows you to stay. Sometimes there's a certain level where they no longer can provide care, but you can transition into needing higher levels of care in that same location. Nursing homes, probably most people are familiar, and then hospice facilities. How is long-term care funded or paid for? There's kind of four big or five big areas that I see. The first one being private or company health insurance. I mentioned that 41% of people needing long-term care are underneath the age of 65. They still may be working. Medical policies sometimes will pay for up to 120 home health care visits a year. They range, but that's the highest that I've seen in most policies. I will say that this differs from disability insurance. Some people say, well, how does that differ from disability? I think I have that coverage. Disability insurance is intended to replace our income if we're still actively at work, if we're not able to perform the material and substantial duties of our occupation. Long-term care is intended to replace or pay a benefit if we're unable to do two of those activities of daily living or suffer cognitive impairment. Typically, we go through our working years and hopefully we don't have a long-term care need ever, but hopefully we go through our working years, the disability stops, and then the long-term care would be available. But people do buy long-term care policies when they're younger and they're healthy and they're able to secure the coverage rather than waiting until we're older and sometimes or more mature, it's more difficult to qualify medically for coverage. I'll speak to the qualifications in a minute. Family assets end up paying for a lot. Sometimes that's not planned. It just happens because individuals haven't done the planning, and then they're left with needing to use their own savings, retirement. Children sometimes help kick in, and sometimes they'll pay part of it. Sometimes you will use your assets to pay half of that $219,000 cost, and then maybe have a policy pay the other part of that or the other half of that exposure. Medicare. This is probably the biggest misconception that people have. First and foremost, Medicare requires that we are hospitalized for a period of 3 full days, and that does not include our day of discharge. If we meet that requirement, Medicare will then pay for our care from day 0 or day 1 to day 20. After day 20, there is a co-payment arrangement where we are responsible in the 2026 calendar year to pay the first $217 of that care bill, and that continues up until day 100. If you own a Medicare supplemental policy, depending upon the plan, many of the plans will cover that co-payment, that $217 for you. And most people will have one that covers it. So you could, I don't want to guarantee, but in a lot of instances, you probably will be covered. At day 100, this is the big shocker for most people. Medicare stops, and you are 100% out of your own assets, regardless of what Medicare supplemental plan you have. Okay. The program, the other government program, I should say, that covers a good portion of the cost is Medicaid. That is a program that requires we've spent down our assets. The numbers range state by state, but as a couple, it's about $80,000, excluding your primary residence if you're living there at the time one partner has a long-term care qualifying event. As an individual, it's down in the $2,000 range. So it's intended to help individuals that don't have other financial resources. I'm going to show you a slide in a second that might shock some of you, where I break out who actually pays for long-term care services. And then the last one is having a policy. I personally don't have the right answer for you to tell you what to do. My goal is I want everybody just to be thoughtful and have a plan and know what they would like or who they would like to pay for their long-term care services so they don't find themselves confronted with a situation where they haven't planned and now it's a fire drill and they're trying to figure out how are we going to cover these expenses. This slide I wanted to share as it breaks down who pays for long-term care. And this is what tends to surprise most people. The government program that covers most of long-term care cost is Medicaid. So that means we've come to a point where maybe we've been paying for our own care and spent down our assets to such a point that we really don't have any more assets. We then apply for Medicaid. Medicare actually pays for 18% of the cost. Private insurance or out of pocket is us paying our own bill, just kind of maybe it kept creeping up on us and we didn't even plan and we need to pay, or maybe we've made the conscious choice. We're going to run the risk, roll the dice, and we're going to pay for it. That covers 14% or accounts for 14%. Private insurance, a long-term care insurance policy, covers 9% of it. And then the other public is going to be like your veterans benefits that one has. Other private might be philanthropic organizations, donations from other people. Is it right for you? I've just listed some of the reasons why people over my time in the industry and what I've heard at different seminars have said this product fits for them. It provides, and the reasons why it fits. It provides one the choice of where you receive care rather than being kind of, I'd say, more held hostage to trying to figure out, okay, now I need to find the money, or I need to see what I'm going to drain, what financial resource I'm going to drain to pay for it. It protects those retirement savings and your assets. Maybe you have children. Maybe you have philanthropic causes that you want to leave a legacy to. Maybe you have a university. There's various reasons and various choices that we have in our estate planning. And so this gives the ability to protect those goals and objectives that we have that will long live us after we pass. The other big thing, having personally gone through this with my father had dementia, so I have lived this not only once, but with somebody else that we were responsible for caring for 12 years before my father's incident, is it allows you to spend quality time with your family. And I think this is underestimated. The flexibility that I had to find a facility for my father where I knew he was going to get good care and that I could come and visit him. And while he was more lucid in the early stages, still have time to get those family memories that I never captured or just time with him and not doing what I call the heavy lifting, doing the actual care myself was priceless. And I think that's underestimated and people echo that and they say, I didn't realize this, Megan, or I'm so glad I had it for this reason. Provides the financial support again, kind of it loops back into protecting your assets. And then it really gives the individual, and this is something I learned from females when I first came into this industry because they were the largest buyers of long-term care at that time, females in their mid 70s, is it was the idea that it gave them independence and their dignity. They did not want to rely on their children. They did not want their children changing their diapers if that was what they needed. They wanted to be as independent as they could. I won't speak to the care planning resources, but policies have the ability for you to tap into some resources that they have for you and or your family in the time of need and when a long-term care events. These are just some questions, and I'm mindful of time. We have about 7 minutes, I think, left of your time. We'll be willing to stay later, but these are some things that I just throw out there for people to give thought to, and it's important to think through these questions, I think, and they're just maybe starter questions to have with your family when you're all next together, because I have seen this happen more often than not. I have been told by people, my kids are going to care for me. And then we fast forward down the road, and the children that maybe said, yes, I will care for you, maybe aren't in a position to care for you. Maybe one of your children has decided to go back to work. Maybe your girlfriend that was going to care for you now is caring for a family member. Maybe you have a sibling that physically has their own health has deteriorated and they're no longer in a position to provide that care. Can you afford the premiums? And I didn't put any premiums on here because that's really an individual one-on-one conversation based upon the plan. And then just going into some other questions is go out and look at care facilities in your area. Stop in, ask what their cost of care is, and become educated. You will be receiving a link from Kyle after this meeting with the long-term care survey where you can go in and put in your city where you reside or where maybe you have a second home and see what the cost of care is. Become informed so that you're aware and you can build that into your planning. And then just kind of, can you co-insure? Do you want to co-insure the risk? Meaning have a policy pay for some of the exposure and then have your assets pay for the other part of the exposure. And that's more common these days. Plan designs being the second to last section that we're going to cover formally. There are many choices that one is able to make when they're designing their policy. And again, one size does not fit all. Everybody's plan is going to look very different based upon their situation. And that I could cover more and more in a one-on-one conversation. But the choices that you would be making are, do I want a facility only policy, meaning it only pays for nursing home or assisted living facility? Or do I want a comprehensive plan that's going to allow me to receive benefits if I'm in my home as well as if I were in a facility environment? How much benefit do I want the policy to pay? We showed you that figure of $200,000. How much per month do you want to receive in a benefit if you had a loss of two of those activities of daily living, or if you had a cognitive impairment? For how long do I want to self-insure? What do I want my deductible to be? So we refer to it as elimination period. That is for how many days that you pay for care effectively before the policy starts to pay a benefit. It's no different than your $500 deductible on your auto insurance. Most common is 90 days, just because that cost point, 180 days, there's not a lot of savings to go from 90 days of paying for your care to 180, but it's significantly more expensive to go with a short waiting period or a deductible period of 30 days. The benefit duration. How many years do I want the policy to pay benefits? To give you an idea, the average duration of care in a facility is about 2.5 to 2.7 years. However, we know that most people start receiving care in the home and they don't even really realize. Oftentimes it's because we're in denial. We're just having our children come by and help us just a little bit. And that amount of care starts to increase. It's maybe a couple hours a week. Now it's more. We sometimes go through this moment, I find, and I've been in the industry for 30 years. I was in the industry for 27 years or 23 years before my dad's health failed. It was hard for me to admit that my dad needed care. And I even know this. I do this day in and day out. So we know that duration can be a lot longer. Inflation. Do we want that benefit to index? So it will go up every year to keep costs with inflation. Shared care. If you have a spouse or a partner, you could each buy a policy that actually would allow your policies to be linked together. So I would own a policy and my spouse would own a policy, but I would have the ability to use some of his benefits if I used all the benefits or drained or exhausted my policy value. And then how do we pay for the policy premiums? You could pay for it maybe like you do your auto or home insurance, you pay for it every single year ongoing, or we can condense those premium payments into a shorter duration over 20 years, 10 years. Write one single check. Not all options, as I footnoted, are available with all carriers, but that gives you an idea. And then the last kind of slide is, what does this process even look like, Megan? The very first step that I do is I I invite people to complete what's called a pre-qualification form. It's a one-page form that asks you about your health history, both past and current. I take that information and then I screen that with the marketplace. We're not applying for coverage. We're going to the underwriters and saying, based upon this medical information, is this person A, insurable now? B, are they insurable, but we need to wait for a period of time because maybe they've had a recent diagnosis or just started a medication or just changed a medication? Or, or are they insurable, but we need to charge them an additional cost? It's called a rated policy. It'd be similar to high risk auto. If you had multiple claims, you might find your auto insurance carrier cancels and you have to go to another carrier that is able to insure individuals that have had more exposure or more accidents or speeding tickets. And then the last piece is, unfortunately, we do have individuals declined. Just in the last 2 days, I've had two couples, all four of them looking for long-term care, and three of them were uninsurable because when they waited to apply. If we find that out, then we would get on a telephone call and we go into deeper dive into kind of the questions and helping to educate you, answering your questions. I give you some tools to look at in advance of our call, and then we start designing illustrations or proposals to look at what does this look like in terms of cost of care. If you then settle on like Megan, we would like to move forward, or whether that's me or somebody else, I would like to move forward with this, then there's a full application that you complete that's specific to the insurance carrier. Likely there will be accompanying that a telephone interview that will be scheduled with you at a convenient time for you, or a face-to-face assessment. It's driven by your age, which one the carriers will use, and they reserve the right to have a paramedical exam done, which would be your height, weight, blood pressure reading. Somebody would come to your home, or you would go to a paramedical company to have that done. Underwriting on average takes about 8 weeks. I say on average because the time can be longer if you have your medical records take longer for your doctor's office to release. So if you're with a larger institution, locally in Seattle, that would be a Virginia Mason, a Kaiser, Swedish. They sometimes take a lot longer because your request goes to their records department and their records department just goes in date order. And our medical records aren't just requested for long-term care insurance, but people buying life insurance, buying disability insurance, and for various other reasons. So it's just, that's the longest, that's the piece that takes the longest amount of time. Once the carrier receives your application, the results of your telephone interview, your face-to-face, and the medical records, they render a decision within 3 to 5 days. And then the offers presented to you. Hopefully there's no surprises because the information that we gave the carrier is accurate in the screening process. But sometimes I've had clients find out notes that their doctors made in their medical records that they weren't even aware of. And those notes maybe translate, unfortunately, sometimes to somebody be uninsurable, or they're postponed for a period of time until a condition is addressed. So with that, and I know, and I apologize, we're just over 1 minute.
No.
I know that Kyle had some preset questions, but we wanted to open it up to any questions that people may have. I know we covered a lot, but the intent was just to kind of give you a little bit of a sampling for what is long-term care, where is care provided, what is the cost, what are conditions that can trigger you. So hopefully we've given you a basic level that makes you either curious to learn more, or maybe it's answered some questions that you had, and you then can make your decision with your family unit that's appropriate for you.
Thank you, Megan. Yeah, I mean, when you told me that 41% needed care for long-term care under 65, I was so surprised by that statistic that just never had really crossed my mind, even as a financial planner. And after talking, it definitely made sense. So I think another observation, types of care facilities, it's interesting all the pricing schemes they have. So some have a deposit you put, which when you pass away, your beneficiaries get 90% of what you put in. Other ones have no buy-in but high monthly, and it's they just really run the range, and I think that's a kind of one of the interesting things that you can do when you run a kind of cost projections and go look in your area, how much are the care facilities, what type of care facilities, and go and knock on some doors. So yeah, if anyone has any questions, feel free to type them in I think the Q&A or the chat there. Um, let's see here, and I have a couple here as well. And these are kind of the questions I hear a lot from people. One is, and I'm going to surprise you with this one, Megan, but
Yeah,
when is a good time to buy long-term care? Probably not when you're 80.
yeah.
And so, yeah,
Yeah, I would say the joke that we say on that is the day before you have a qualifying event, before you've received a diagnosis. We say that just jokingly, trying to make
yeah,
a heavy subject light. But the reality is there had been many years where the likes of Susie Orman and I'm trying to blank. There's another gentleman, but some people that were in the public light would say 65, right when you retire. That philosophy has been dispelled, because what we find is two things. The health that you have is only as good as it is when on that day. And typically, the longer we live, we have the opportunity to have a diagnosis happen or be in an accident that we don't cause it, but somebody else causes it. So I really encourage people to start looking at long-term care in their early 50s, because also the other factor is that the cost of long-term care, and I didn't touch on this, but the cost of long-term care um, goes up the older you are when you buy the policy. So if I compared a 50-year-old versus a 60-year-old buying long-term care, there's a pretty significant difference. It goes up dramatically anytime after 60. The year-over-year change is more. And it's more to the point that people will say, well, Megan, if I buy at 50, I'm paying for 10 more years versus buying at 60. I always tell people if you add in, if we look at inflation on the policy, and what inflation does is it increases that monthly benefit that I showed of 1,500 to around $12,000 a month. It increases that every year. You would have to factor in the inflationary increase on your benefit. So you run it at age 50 at say $6,000 a month benefit. You're looking for a co-insurance situation. Then that's at age 50. Then at age 60, you would have to increase that number to what would that $6,000 have grown to? And so that gets compounded plus the added complication of what does your health look like now at 60? And that's the unknown. So I would say definitely in the 50s. Unfortunately, the last two people that I helped, and it's not uncommon, they were these four people, they were 77, 76, 75, and 78. And I shared with you three of the four of them were not insurable.
Hmm. Um, Speaking of inflation, how important is that inflation protection? Do you almost kind of always recommend? Because I've seen healthcare costs projections go about 5% per year, but
Hmm.
I think a lot of that probably depends on the type of care and when you need it and how long you need it.
Yeah.
And obviously the 5% inflation rider is going to be very costly relative to the others.
I do. I recommend inflation. What I do is I ask a lot of questions and I tell everybody this when we first start the interview. I'm going to ask a lot of questions and they're going to feel very personal. And you only have to share what you're comfortable. But the more you share with me, it actually helps me factor in the longevity that you have in your family. Is it as important? I worked with one lady early on in my career who everybody in her family died at 65. I mean, it was very frightening. She had her parents, her two brothers, and one sister had all died at 65. And so when we were designing her plan, we made different choices in the inflation option that we elected. 5% is the largest inflation that can be purchased. I personally prefer not to go that high. And I know that there might be another question that Kyle might be asking me about this, but I personally prefer not to go that high because with a 5% inflation, what that does to the insurance carrier and their risk is that every 15 years, their risk doubles. So what their liability, so if I started with $6,000 a month of benefit in 15 years, when you have a 5% compounding inflation effect, that will have doubled to $12,000. And so if you take that 50-year-old buying or 51-year-old buying, by the time they're 65, late 60s, it's doubled. And then you're going to have their likely longevity. They could live till they're 80. You're going to have another doubling effect. And so the exposure to the carrier is higher. Hence, they charge a lot more for that
Hmm.
5% compound inflation versus other options.
Okay. And I've seen some, and we've talked about this in the past about pricing of older policies, but um, carriers will come back and raise rates and then give you an option. Option one, pay the new rate and maintain your benefits. Option two, don't pay anything more and you keep a static level of benefits. Option three, pay a lower rate and with reduced benefits. And sometimes I've even seen 5 or 6 options that we have to go through. Is that becoming less common, more common? What are your thoughts on that?
Yeah, great question. So the first long-term care policies, they're relatively new. The first policies were sold in 1974, and it was actually because there was a nursing facility out in Bothell, Washington, that the owners were finding their patients were running out of money, and they weren't able to pay their monthly cost for being in the facility. So they got the idea to maybe we could create a policy that would pay the monthly bill, and that's where long-term care started. And so what happened is they used the other type of health insurance policies that they thought were as close to long-term care to price that risk. Obviously, as you get more experience and more data, you learn more. And what we learned, and we saw the first round of real, to be very honest, very large increases happened in the early 2000s. And what they attributed that to were a couple of factors. One was that they were seeing that the lapse ratio assumptions that they had made, and the lapse ratios are the number of people that will they will buy a policy, they'll begin paying premiums, and at some point they'll cancel it, maybe before they've even received any benefits. This product I should insert now is just like your homeowners or your auto insurance or your homeowner's insurance. If you've paid off your mortgage and you decided to cancel your homeowner's policy, bet you wouldn't do that, but if you decided to do that and you had a fire 3 months later, you would have had no, you paid all those premiums, but you would have had no benefit because the policy wasn't in force. So the number of people with long-term care that canceled their policy, they thought about 7% of the people would cancel their
Mhm.
policy. What they found in the early 2000s when looking at an audit of the book of business is that less than 1% of people canceled. And that has a big impact on their pricing model that they need to use. The second impact is the insurability. When I started in long-term care, people under certain ages didn't even have to do they didn't even have to have medical records pulled. They would just fill out an application. Well, if you think about that, some people don't like going to the doctor. So you have no way to know if you've got something that's going on, a blood condition or some other condition that's going on because you're not going to the doctor and having your blood drawn, your urinalysis done. So then you might actually be at risk for being sick. And so what happened is those carriers realized they started to see a lot of claims in those people because they never gathered enough data and their medical underwriting maybe wasn't as good as it should be. And then the last aspect was the return on their investment. This is a product that has a very, very long tail or very, very long liability for an insurance company. If I buy at the age of 50 or 55 and I live till I'm 90, that is a very long exposure for the insurance carrier. And so they cannot afford to be aggressive in their investments. They're very conservative, lower rates of return. And so they had to adjust their assumptions based upon that. To your answer, circling back to your question, is that I will not guarantee, I tell everybody when we design a plan, we want a budget for a rate increase because I think
Mhm.
it's fair to say that there's a good chance you'll have a rate increase. Do I think that we're through a lot of the very, very large ones? Some of the carriers that wrote those policies are still increasing those rates, but going forward, the pricing has been adjusted to reflect the low lapse ratio. Medical underwriting is very difficult. Why three people just got declined this week when we were doing their exploration or their pre-qualification, and their assumptions on the interest rates and the return on their investment is appropriately priced for what we're seeing in the marketplace as a whole.
Thank you. I'm just going to double check chat again here. Okay. Um, Maybe one more question because I know we're a bit over time. So one more question. Um, who is long-term care insurance probably not a good fit for?
So in terms of conditions, kind of the leading causes, there's a checklist, and I actually have it on this one. Kind of the uninsurable conditions that we see a lot are MS, Parkinson's, stroke. That even includes individuals that will say you might have heard the term mini stroke or TIA,
Mhm.
stands for transient ischemic attack. Metastatic cancer, I've just run into two of those in the last month. Insulin dependent type 1 diabetics. We can insure type 2 diabetics, but if they're insulin dependent, that would still disqualify them if they're taking metformin, which is an oral medication, and their A1C readings are good. Those are the common ones that are uninsurable, like that are not insurable. Equally, if I can just add kind of, I think, what question that people might ask, or what are people go out on claim for? What are the common conditions that
Mhm.
people find to go out on claim? Just jotted down kind of the common ones are cognitive impairment. I don't like to say that, but very common. And those last a long time. My father's, from the time of his diagnosis to the time of his passing, was, my gosh, 12 and a half years. Um, Chronic conditions, so that I would lump that Parkinson's, MS, heart disease, diabetes, sudden medical events like a stroke, a heart attack, traumatic brain injuries, and then injuries, just general injuries. Just you're living your life. You're an active person. You go out and you climb the mountains. You're a cyclist. I see a lot of people that are cyclists that are on the road in their cycling groups. Somebody clips their wheel. I was a cyclist. That happens all the time, and we find they oftentimes go head over
Handlebars
their
there.
handlebars, and even if they have a helmet on, sometimes there's unfortunately cognitive issues um, that start at that point in time. So it's kind of across the board, but it isn't to say, I'd say the one thing I'd say is that cancer by itself does not necessarily mean you're not insurable. We look into the stage of the cancer or grade based upon the type of cancer. We look into when you had it. If it ever metastasized, then that's unfortunately going to be one that's not insurable. Depending upon the amount of time since you're last released from care factors in. So cancer isn't an out, but it is interesting because I've shared with you, Kyle, over the last 9 months, I've been helping a very dear friend who's 56 years of age with some medical stuff. Turns out she had lung cancer, which is happening younger and younger, as a byproduct of having some issues with her eye, and she hasn't been able to work. And she said to me, I can't get long-term care now. And unfortunately, early on, she was hoping she could get it because she hadn't got it. And now we know she can't get a policy. So,
Well, it's a yeah, it's a topic that definitely is going to impact all of us, and I think you have a great slide
oh,
that
yes. Thank you. My last slide.
highlights that. Yeah, I like this quote. So, the four kinds of people in the world. And we're lucky that we have people like Megan that can educate us and guide us through this. And so obviously I'll be sharing her contact info as well as slides and recordings and answering any questions, follow-up questions that people have from this presentation. And thank you everyone for sticking around. I know we went a little over. And so maybe the next webinar will be 30 minutes with 10 minutes
So I'm sorry, I
Q&A.
tried
No,
to,
no, no.
but this is helpful.
This was a first in a series, so we'll be doing these quarterly, and hopefully Megan will agree to return next year, and we'll do kind of a long-term care series with her. So thank you everyone again.
Thank you.